Tesla apparently has the potential to be worth $40 trillion, with its stock hitting explosive levels. What are Tesla's $40 trillion opportunities? It comes from Morgan Stanley's Mother of All CapEx Cycles research paper. What is the central theme of this research report? And will the next 12 months demonstrate to investors how Tesla and the rest of the auto sector are critical to the transition away from fossil fuels? Keep watching to find out. Electric vehicles could play a major role in re-architecting the renewable energy/transport economy, assuming the entire car industry moves to electric vehicles. Many believe the entire globe is about to be operating on batteries, making the next battery invention and the materials that go into it the best way to profit from the multi-trillion-dollar energy transition's lucrative momentum. According to Bloomberg NEF, investment in the global energy transition reached a record $501.3 billion in 2020, and large money is pouring into new energy in a way that befits a revolution. Institutions, foundations, and endowments with over $14 trillion in assets are poised to support an energy transition. Forbes refers to it as a paradigm shift. This is a substantial sum of money, and one of the investors' concerns with legacy automakers is that they have a sizable industry based on internal combustion engine vehicles. Legacy automakers are attempting to serve two matters with this massive commitment: internal combustion engines and electric vehicles. They can only service one customer, and if it isn't electric vehicles, they will go bankrupt. Also, clean energy is getting significantly less expensive. Electric vehicles will soon be as inexpensive as conventional automobiles, maybe as early as 2026 or earlier, and energy storage costs are also falling at a rapid rate. And the key to it all is storage. All of this is impossible without sophisticated batteries, which necessitate the use of battery metals. Tesla currently has the lead in this industry on the electric vehicle front and renewable energy in general. Harnessing this shift will boost the brand even further and possibly double or triple its worth. Tesla is both overvalued and undervalued, according to Morgan Stanley. Tesla, they believe, is expensive as a pure vehicle company, but it could be greatly undervalued as a renewable energy onshore infrastructure company. Tesla is seen as the ultimate battery capex investment, according to them. According to Morgan Stanley, energy innovation will be rewarded as a result of two key events: war and inflation. With present circumstances, we believe that developments in the next 6 months will have a significant impact on the narrative surrounding what Tesla does, the markets it serves, its growth profile, and the global strategic implications of the ecosystem on which it sits. Many investors are also beginning to see the benefits of Tesla's direct-to-consumer model, something legacy automakers are unable to execute due to powerful state dealer franchise restrictions. Instead, it cuts out the middleman and reduces political play, therefore allowing the brand to properly serve its customers. Basically, Tesla may sell automobiles whenever and however they want. Legacy automakers employ antiquated dealerships with antiquated sales practices, as well as additional partnerships and red tape that wreak havoc. Morgan Stanley believes that the multi-deca-trillion-dollar battery capex cycle is being driven by larger causes. As globalization progresses into a new era marked by increased national security concerns, investors must consider the new energy supply and infrastructure. Battery storage will be critical in the future, and Tesla is well positioned to lead. Tesla will be able to produce more batteries than everybody else, as Elon Musk has claimed that Tesla will likely start their own mining operations, either by acquiring mining businesses or starting their own from scratch. It's encouraging that Morgan Stanley is considering Tesla's options beyond the automobile industry. Their price goals and earnings per share predictions, on the other hand, are perplexing and much below what many investors perceive. When Tesla's market valuation surpassed $1 trillion last year, many naysayers were shocked, to say the least. This was a milestone previously only achieved by Apple, Microsoft, Amazon, and Alphabet, thanks to a $4 billion deal to sell 100,000 vehicles to Hertz, a rental car firm. However, it's important to note how Elon Musk's company differs from the rest of the pack. For one, it's rated as a trash bond. As a result, Tesla's long-term debt was recently upgraded to BB+, which is one rung below investment grade. Its sales and profits are significantly lower than those of competitors. Tesla is expected to make $6 billion in revenue this year, a fifth of Amazon's and roughly a 20th of Apple's. The dispute over Tesla's worth still continues. Tesla is worth more than almost every other major automobile manufacturer combined. Analysts are split on where it stands at the moment. Tesla hitting $1 trillion is just for starts, said Daniel Ives of Wedbush Securities in a recent tweet. In the bear camp, Roth Capital Partners' Craig Irwin expressed in a client note that Tesla's stock was egregiously expensive, at 173 times next year's earnings. As a result of multiple countries cutting EV subsidies and the current macroeconomic status, analysts predict the market to consolidate, with poor brands certain to be wiped out, according to the analysts. So how is Tesla presently faring? Tesla investors have had a roller coaster year. The stock began the year at a price of around $1,200 per share. The stock price of the automaker then plunged to values much below $800. The shares of the electric vehicle manufacturer are currently trading at just around $1,000. Much of this volatility reflects the company's tremendous uncertainty about its future, particularly in the short term. The company's production rates are suffering a hit as a result of a manufacturing halt in Shanghai due to government-imposed COVID-19 restrictions, and no one knows how much. Fortunately, according to Reuters, the company plans to begin operations at its factory in China soon. However, given the requirement for third-party supplier involvement, it would be strange to see a sluggish ramp-up back to former production levels. When Tesla announces its first quarter results on the 20th, investors will be hoping for some answers. How quickly does the automaker expect its Shanghai plant to resume production after the shutdown? Is it possible for Tesla to meet its full-year vehicle delivery targets? As a result, when Tesla reports earnings this week, any projection the firm makes for full-year vehicle deliveries will be the most critical item for investors to watch. While a 3-week stoppage at Tesla's Shanghai production increases the chances of the firm needing to lower its full-year vehicle delivery forecast, there's still a chance it may meet its initial forecast. The company's new plants in Germany and Texas are at the heart of this issue. Management stated at the automaker's fourth quarter update that it could likely achieve growth of more than 50% without the contribution of these new plants. But since that time, both factories have gone online, and both have the potential to become significant volume drivers for Tesla. Thanks to the 2 new plants, Tesla is entering a new chapter of expansion. Elon Musk chose to begin things by hosting Cyber Rodeo at Giga Texas, which will eventually become the company's headquarters. As Tesla frequently does, Cyber Rodeo generated free advertisement with an estimated 15,000 invitations handed out and more viewers attempting to attend without one. The event drew large crowds. Musk also included an update to his business plan in his presentation. He predicted that 2022 will be the year of scaling and that 2023 will bring a slew of new products, including Semi, Roadster, and Cybertruck. Tesla further stated that this new facility is a feat of engineering because it's the world's largest factory by volume. As a result, Tesla's ability to integrate all parts and operations under one roof rather than separate buildings like earlier manufacturers is even more astounding. We believe that Tesla's cost leadership in battery/powertrain technology is a critical competitive advantage that has allowed the business to produce price/performance competitive electric vehicle models, compared to internal combustion engines, considerably ahead of its competitors. What does Tesla stock have in store for the future? Tesla's stock price in the future will most likely be determined by the rate of transition to electric vehicles from conventional fossil fuel engines, as well as the company's financial performance. As we mentioned earlier, with Tesla being in the lead, this $40 trillion opportunity is ripe for the taking. We believe Tesla will be well positioned to profit from the long-term shift to EVs, given its leadership position in EVs. Tesla's financials should gain from the Model Y's ramp-up, as well as new factories in Berlin, Germany, and Austin, Texas, and, in the long run, an increase in its proportion of electric vehicles. What are some of your Tesla predictions for the second fiscal quarter? Comment down below.